Today, let's talk about 401k plans in more depth. 401k plans are the most popular retirement plan in the United States today. And many companies offer 401k plans. Many companies feel compelled to offer 401k plans as a means to attracting employees that are valuable. What makes 401k plans popular? I think from an employer's standpoint, the employees get to participate in the plan. I hear clients many times that have defined benefit plans or profit sharing plans where the employees do not contribute to the plan, and they don't feel like the employees appreciate the plan. They don't understand the plan. They don't appreciate it. Once a year they get a statement that shows them the value of their accounts, but they just don't feel that they're getting as much bang for the buck, so to speak, in a defined benefit or profit sharing plan as they do in a 401k. 401k plan, by contrast, the employees get to participate. It's good for the employees because they get to decide how much to contribute of their own pay into the retirement plan. They get to have a direct impact on their retirement. They get to save for their retirement. They get to save part of their own salary on a pre-tax basis. So it's a tax benefit to them today. And in most 401k plans, the participants then also get to decide how to invest their contributions in the plan. Some don't allow that, but by far most 401k plans allow you, the participant, to direct your investment among investments that have been pre-selected by the plan. So most popular because for employers it's good, for employees it's good, becomes the most popular plan. 401k plans, it's important to know that there's a qualification test for a 401k plan that has to be satisfied at the end of every year. The qualification test is designed to ensure that the owners of the business, the highly compensated of the business, we'll come back and define highly compensated. The test is designed to ensure that the owners and highly compensated don't take unfair advantage of the plan when compared to the rank and file employees. They don't want an employer, the government doesn't want an employer to put in a 401k plan and forget to tell the employees about it so that just the owners and supervisors can contribute to the plan. So there is a test at the end of the year that has to be satisfied that compares the amount of money saved on average by the owners and the highly compensated in comparison to the amount of money saved on average by the rank and file employees. In general, those averages can't be more than 2 percentage points apart. It can be a difficult test for many companies to satisfy, which is why at the end of the year you'll see articles and letters in business journals and in financial sections of the newspaper. Why can't I contribute the maximum to my 401k plan? Why am I getting money back from my 401k plan? And the answer is because of a qualification test that will limit sometimes what the owners and the highly compensated can contribute to the plan. I'll just take a sidebar for 1 second. Highly compensated is a term defined by the Internal Revenue Code. In general, it's an employee that makes over $110,000 a year. It's a little more complicated, but in general, any employee that makes over $110,000 a year is going to be highly compensated. So 401k plan has a qualification test that has to be satisfied at the end of the year, which is why it's important in a 401k plan that the plan be marketed to employees, that we have regular periodic employee meetings, that we educate the employees on the value of a 401k plan, on how important it is for them to save part of their own salary for retirement purposes, why we need to educate them on investment alternatives, how to diversify their investment portfolio, what is a stock, what is a mutual fund, what is a bond, and so forth. So employee meetings, marketing become very important in a 401k plan. And that's an ongoing marketing need. We run into plans all the time where somebody has installed a 401k plan 2 or 3 or 4 years ago and they've never seen them since then, and the plan is drifting along, and that's a plan that ultimately is doomed to failure because a 401k plan requires ongoing employee communication to ensure that the employees understand and are participating in the plan. A basic 401k plan allows employees to defer part of their own salary. There may or may not be a company matching contribution. Let's talk about that for a second. A company matching contribution is not required. A company matching contribution, if the company desires one, can be the sky's the limit on how we design a matching contribution. The simplest might be a 100% match on employee deferrals up to $100 a year. or a 50% match on the first $1,000 that an employee puts away, or a dollar amount, 50% match up to the first 3% of an employee's pay that they put away, or no limit on a match, 100% match with no limit. So there's many ways to design a 401k match. Our goal, again, is to listen to you, the business owner. What is the goal of your plan? How much does the company want to contribute to the plan, commit to the plan? That will help us determine the size of a match that we want to do, depending on how many employees and participation and so forth. But we'll design a plan that will use the dollars that you want to commit to the plan in a matching formula. And then, so there's three sources of money in a 401k plan. There are the employee deferrals that we've talked a little bit about. There are matching company contributions that we've talked a little bit about. And the third is a company profit sharing contribution. At the end of the year, many companies decide to make an additional contribution as a profit sharing contribution to the plan. The difference, of course, is a matching contribution matches what the employees have put into the plan and only goes to those employees who have contributed part of their own salary to the plan. By contrast, a company profit-sharing contribution goes to all eligible employees, all the employees that are eligible for the plan, whether they've made any contributions to the plan or not. The advantage of the profit-sharing contribution at the end of the year is oftentimes that we're going to get many more dollars into you, the business owner, to your pocket. There are testing and allocation techniques that allow us to focus sometimes contributions to the business owner, and the profit-sharing contribution is a way sometimes to maximize what the business owner can get out of the plan vis-a-vis the rest of the employees and so forth. Many options in a 401k plan. A safe harbor 401k plan, very popular today. As I said, a 401k plan has a qualification test typically that has to be satisfied at the end of the year. A safe harbor 401k plan gets a free pass on the qualification test. They get an automatic pass on the qualification test. To be a safe harbor plan, the company has to commit to making a company contribution each year, either a matching contribution or a profit-sharing contribution. A profit-sharing contribution would be a 3% of pay contribution for all eligible employees. The matching contribution would be, it's a little complicated, a 100% match on employee contributions up to 3% of their pay, plus a 50% match on contributions from 3 to 5% of pay. So we'll simplify it and say that the matching contribution would cap out at 4% of pay. Safe harbor plan, company has to make one of those two contributions. The company decides at the beginning of the year which contribution they're going to make. They have to make a written notice to the employees, give a written notice to the employees of their safe harbor election for the year. They can stop in the middle of the year if they need to, but that doesn't typically happen. The final comment on safe harbor plans is the company contribution, whether it be a match or the profit sharing safe harbor contribution, those contributions have to be 100% vested to the employees immediately. So a safe harbor plan is a great plan in the right environment. There is no qualification test. The owners, the highly compensated, can defer up to the annual limits. We don't care what the rest of the employees do. The downside is there's a company contribution that's required, and that sometimes is more than a company wants to commit, but it's a very popular plan. Safe harbor 401k plan. Then again, there are additional options. We can add Roth 401k features to a 401k plan. Traditional 401k contribution is a pre-tax contribution. The employee pays no federal or state income tax today on the dollars that they contribute to the plan. So if they contribute $100 to the plan, it may only cost them $80 or $75 of take-home pay because their income taxes are also reduced. In a traditional plan, when they then take a distribution at retirement sometime in the future, all of their accounts are taxable as ordinary income when they take the money out of the plan. All of the contributions that they put in, all of the investment earnings that have been generated by their accounts, all of that is taxable as ordinary income at some point when they take it out in the future. They get a tax deduction today for the contributions. They're going to pay taxes on it in the future. A Roth contribution, by contrast, is very similar to a Roth IRA. The contributions that the employee makes today is not a tax deduction, so that there is no reduction in their income taxes today for the Roth contribution. It's an after-tax contribution. The advantage is that in the future, all of the Roth contributions and all of the investment earnings on those contributions can be distributed to the participant completely tax-free. There's a couple simple requirements that have to be met, but they're very, very simple. But in general, the Roth accounts are going to be distributed entirely tax-free in the future. For younger employees, for those in their 30s and 40s and younger, Roth accounts can be very, very exciting because the interest accumulation over 15, 20, 25, 35 years to retirement, all of those monies coming out tax-free in the future, there can be a great advantage to Roth contribution. That's a simple addition to a 401k plan. In the right, again, our job is to look at the employee population that you have. Some companies, the Roth contribution makes a lot of sense, particularly where the employees are a little more educated, a little more sophisticated. Compensation limits maybe are a little bit higher. Some companies, manufacturing companies or blue-collar type companies, sometimes the Roth just becomes another piece that complicates the plan, and we may not suggest it or we may not recommend it because it's another moving part that people have to understand, and we try to keep the plan simple. So you can have pre-tax contributions or Roth contributions in a 401k plan. The last point I would talk on 401k plans has become very popular in the last couple of years, and that is automatic enrollment 401k plans. In a traditional, typical 401k plan, you give the employee the opportunity to sign up for the plan. You explain the plan to the employee, you give them election forms to sign up, and the employee has to fill out the election forms, has to sign their name to an election form, turn it into the HR department to sign up for the plan to join in the plan. An automatic enrollment plan, by contrast, works that they are automatically enrolled in the plan. They don't have to do anything to be in the plan and to start having some money withheld from their pay to go into the plan. They do have the option, of course, to opt out of the plan. They can complete the election form that says, I don't want to participate in the plan. But at the outset, they are automatically enrolled in the plan. The advantage of an automatic enrollment plan is sometimes those companies that are having difficult time with their qualification test issues that we talked about already. An automatic enrollment plan is a way to increase employee participation in the plan. Employees are automatically enrolled unless they opt out of the plan. So an automatic enrollment plan sometimes can be very, very helpful to the qualification test issues, which help the highly compensated and the owners of the business maximize their contributions to the plan. Automatic enrollment plans, sometimes I have employers that just have a benevolent feeling to their employees, and they want their employees to have a good retirement, and they know sometimes left to their own designs that we don't save enough money on our own, so they put in an automatic enrollment plan just to try to get their employees to save more money for retirement and so forth. But automatic enrollment became very popular the last few years. The federal government passed a law a few years back that made clear that federal law trumps state law. There was much controversy before that about whether you could take people's salary and defer it into a plan. State law said no, you can't take people's salary and so forth. Federal law passed. That's very clear, very popular today, and increasing part of the marketplace is automatic enrollment plans. And 401k plans, there's a lot of administrative issues as you get into a 401k plan that we would discuss with you. Participant investments. Do we want to give the participants the ability to direct their own investments, to select investments within the plan, or is the trustee, the employer, going to maintain investment control? There are still some small employers that it's more complicated to give investment discretion to the employees, and so the employer will still keep investment direction of the plan. Most 401ks, by far most 401ks, allow the employees to direct their own investment. Then we have to get into selecting an investment advisor, and we have to get into talking about whether the investments are what we call a daily valuation platform, where the participants can go online on the internet, view their accounts, move monies between accounts on a daily basis, as opposed to a pooled environment. Again, the daily val, very, very common today, most popular today, that allows participants internet access to their accounts to move and see their accounts. They can't withdraw their money, but they can move between investments and see their accounts. So the investment issue in a 401k becomes an important issue that we consider. The design of the plan, whether we have a matching contribution or not, again goes back to company objectives and company dollars that they wish to commit, for instance. So as I said in my first video, the most important thing we do is try to sit down with you, the business owner, educate you a little bit on the types of retirement plans out there, the pitfalls in retirement plans, and the rewards of retirement plans, and then listen to you as to get feedback from you as to what your business goals and objectives are, and understand your employee population and how they fit into your goals and objectives and so forth. Then we'll design the plan and all the bells and whistles that may go with it and so forth. At our company, we believe we're the HR department for your 401k plan or profit sharing plan or defined benefit plan. I kid my clients oftentimes that my clients, they want to know how to spell 401k. That's all they want to know. They want to rely upon us for everything else, and that's what we're there for, is to be your HR department for whatever type of retirement plan that you want to have. When you're ready to start a retirement plan, we have a simple employer questionnaire that we get basic information on your company, the tax ID numbers, legal name of the company, who the owners of the company are, directors of the company, etc. And then we would talk to you again about all the variables that are available in a retirement plan, whatever type of retirement plan we have. The eligibility requirements. We can require employees have to be employed for 1 year, perhaps even sometimes 2 years before they're eligible to come into the plan. By contrast, many companies want employees to come in after 60 or 90 days because that's when their health insurance may become available, and it becomes easy to have a common entry date and so forth. So we talked to you about eligibility of the plan. Do we want to allow participant loans in the plan? Do we want to allow hardship withdrawals in the plan? We've talked about investments and so forth. So we get the plan parameters that we specify from you. Then we put together the legal plan document that's required in the board resolutions and so forth. They get filed with the Internal Revenue Service. We look forward to working with you. If you have questions, we've in a series of videos tried to put out considerable information on the types of retirement plans, on why businesses should sponsor retirement plans, on the form of business organization that you have doesn't affect the retirement plan, and so forth. Obviously, we hopefully have generated additional questions. We would love to have you contact us via phone, via email, fax, any of the ways, email. Contact us with questions. We'd love to dialogue with you and sit down face to face and discuss a retirement plan. Again, the most important thing is, what are you looking for in a retirement plan for yourself as an individual business owner? What are you looking for in the retirement plan for the business, and how we can help you meet those goals and objectives?